Our clients have benefited greatly from owning Bitcoin in their portfolios. So today we'd like to share the top 3 reasons why you should consider owning Bitcoin in your retirement. And honestly, if you've been told it's just way too risky, reason number 2 will explain why it's just the opposite. So let's dive in. The number one reason to add Bitcoin into your retirement portfolio is that it can boost your returns. And most people hearing that, they're probably like, well, yeah, of course, we've seen Bitcoin perform well, in the past, but will it continue into the future? That's a conversation for another day. But I want to dive into past performance on Bitcoin and how it can actually improve your portfolio, even if you're in like a 60-40 right now and may have just a small, tiny allocation to Bitcoin. But before we get into any numbers, I just want to connect this to the outcomes that you want to achieve in your retirement. We can, as finance guys, we can jump into the numbers, and we love talking about the numbers all day. But for you, a retired person, you're more worried about, okay, how does this money or this wealth or these better returns actually translate to my life in retirement? And so, even adding a small allocation to Bitcoin could give you the ability to spend more in retirement, or give you more peace around everyone's biggest fear in retirement, which is running out of money. That seems to be always the number one in every survey that I see, from financial institutions or other organizations. It's like, that's the number one. I fear running out of money because it's 20-30 years of living off your assets, and they're constantly fluctuating in value these days because you're forced to be an investor, but we won't get into that in this one. Or you could give more, in retirement, have a bigger financial legacy, bigger financial impact on the organizations around you, whether that's a charity, to your church, or maybe just to your family. Pass down more generational wealth with the assets that you've been able to accumulate. So that's how Bitcoin's higher returns, or your portfolio's higher returns, could, at the end of the day, benefit you in your retirement. And that's why it's worth looking into. Even if you come to the conclusion that it's like, well, I don't really want to go down that path. I would disagree, but I just encourage you to at least have an open mind when you're listening to the rest of this conversation. So anything to add to that, Jacob, before we get into more of the numbers?
No, let's jump in.
All right. So I just put together some quick high level numbers on Bitcoin's annual growth rate since 2011. So since January 2011, which is super early Bitcoin. So these numbers are going to be extreme, of course. But that's really, Bitcoin initially was released, we'll say, in January of 2009. But, we didn't really get a market price until 2011. So since 2011, Bitcoin is at 141% compound annual growth rate. Pretty substantial, versus the S&P 500 at 12.99% since January 2011. And then a 60-40 portfolio was the other one I wanted to throw in here, just because that's a super common traditional portfolio allocation to have in retirement. We would argue that that's probably dead and setting you up for failure into the future. But the compound annual growth rate since 2011 has been 8.6%. And that's with an annual rebalance, I should say. So, annually you are going back to these allocations of 60% stocks, 40% bonds. More recently, though, if we just kind of exclude the higher Bitcoin returns, the compound annual growth rate since 2018, because if you don't know the history of Bitcoin, 2017 was a major bull market in Bitcoin, and it went up, I don't know, a couple 1,000% or something just in that year, something crazy. But since 2018, Bitcoin's compound annual growth rate is 27.9% versus the S&P of 12.41 and the 60-40 of 7.75. That's with the annual rebalance as well. And then the last period that I'll just say here before I open it up to you and your thoughts is since November 2021. This is arguably, worst time to buy Bitcoin if you're excluding, the most recent all-time high, end of December or maybe even in January. I can't remember when we hit around 108 or whatever it was. But if you're kind of taking a more longer term approach, you go back to November 2021. That was the all time high of the past Bitcoin bull market. And since then, Bitcoin is still compounded at 9.78% versus the S&P at 7.27 and the 60/40 at 3.15, which, man, that's pretty rough. And that's with the rebalance as well. So just with those numbers, I mean, any thoughts to add there? I mean, it's pretty straightforward, but yeah, what do you think?
Yeah. I mean, anytime you start to get down this, well, Bitcoin adds performance, you hit on it. It's like, well, that doesn't mean it's going to continue into the future. And sure, it doesn't. But also, stock returns, even though we have more historical data,
Yeah.
and so it may feel like, because we have that more historical data, that it's a more sure thing that that's going to continue into the future. It also doesn't mean that that is either, right? Yeah, we've got more history to kind of say, hey, yeah, you know what, stocks are going to continue to perform through different types of market environments, and sure, they'll have their periods where they might not perform as much, but they're going to continue to perform at some reasonable expectation level, and that's not wrong. But that is the biggest hiccups to this sort of stuff is, yeah, you start talking about Bitcoin, and yeah, we've got 2011, a 14-year history, which is better than like a 4-year history, right? But it's not good as 114 plus like you have with traditional markets for sure. So we're very well aware of that, for one, and it's something to be aware of when making the allocation decision for Bitcoin, right? Is sure, it's had some really crazy performance early on, even in the last, as we showed here, 6 or 4 years. Yeah, it still has had some pretty crazy performance even across that time frame. Um, and so who knows if that continues into the future, but we have a framework that we can guide folks through to say, hey, this is why it might actually continue to do, maybe not the performance we've seen, but what we like to call the kind of fastest horse in the race, at least over, the kind of medium term into the future. Obviously, no guarantees with that at all, but there is a way to understand what that could look like into the future and why performance would continue to happen. So, yeah, when we're talking about these numbers, like, okay, so if we are okay with there being less history to Bitcoin, with it being a literally entirely new asset and asset class, and understand that yes, there's risk there, but in risk lies opportunity, then okay, that's where we can get to some of what we're talking
Yeah.
about here, and that okay, maybe Bitcoin can be a part of a portfolio. Why might it be? Well, if we use any of those historical periods, it increases performance. And to your point that you started with, so it's like, if we have higher performance, then all of a sudden we can reach more of your financial goals, reach your financial goals faster. Whatever really it gets to, it opens up more opportunities, to say the very least. And so that really is the
Yeah.
compelling part here is when, as soon as we started talking about boosting returns, it's like, okay, that's exciting. And the thing you didn't talk about here, but is definitely, I think, worth mentioning is, when we run, again, these are back tests, so it's historical data we can see. Again, doesn't mean it's going to happen in the future, but when we run these historical back tests and include, like, for example, let's say we include like a 5% allocation to Bitcoin, not only do the pure returns, which is what you're talking about here, increase, right? So the total return amounts, with these numbers increase. Also, the risk adjusted returns increase. So risk adjusted returns, that's when we account for whether it's drawdown in a portfolio, volatility in a portfolio, whatever it is, those risk adjusted returns increase as well. So it's not just, basically what we're trying to say there is, it's not just we're getting excess performance and that's it, right? We're also getting increased risk across the board, and so we're not really net better from that perspective. No, our risk adjusted returns are actually better as well, and so that's kind of especially for
Yeah.
individual investors, financial advisors. That's what we love to see. If we can get higher risk adjusted returns, that's a double win for clients, right? If we can get higher returns, okay. We can get higher risk adjusted returns,
Yeah.
even better, because now the client experience is going to be better as well, right? It doesn't mean that it's necessarily not going to be any more
Yeah.
downside. It can be, but it's just saying, okay, accounting for that downside, accounting for that volatility, you're being rewarded more for that than what you would with a normal portfolio. So, I think to me that's the cooler part than the peer returns
Yeah.
is, hey, like we are actually being compensated
Yeah.
extra for that, maybe additional risk we're taking and including Bitcoin in a portfolio. And of course, if that's something you can stomach, that additional risk, then okay, yeah, let's have that conversation and find that out. If we determine you can, okay, then that begins the allocation discussion.
Yeah, absolutely. And one thing I want to just reiterate that you said there that I think is important here is, within risk is the opportunity. And, when we're talking about the historical data that we have for Bitcoin, yeah, it's only 14 years, but that's still quite a long time. I mean, it's not like this thing just came out yesterday. And it's pretty impressive, what it's been able to grow into from where it started in just a short amount of time, over these past, 16 years for the full life. If we go back to 2009 versus just when the market price, finally, well, there was a trading price, I suppose. There's no CEO, there's no marketing department, there's no single person that's behind this pushing this. This has organically grown to a $2 trillion asset in a matter of 16 years, and now it's held on the balance sheets of companies. Of course, a lot of individuals, but now we have companies holding it on their balance sheet. We have the ETFs, we have governments holding it, in their treasury assets. So it's honestly just, if you just take a step back and just look at the progress that Bitcoin has been able to make over that time frame, it's like, well, Bitcoin's pretty ingrained in the financial system at this point. And so, it's even though, yeah, we may have 100+ years of stock returns to say what's going to happen into the future, this is a pretty good time, we'll say a risk adjusted time, to buy Bitcoin. Because if you were going to buy Bitcoin in 2012, there was a chance, very good chance, that it was never going to become anything. It was you just wasted your money right there. But now in 2025, it's like, well, okay, when you have, all this regulation in place now, it's very clear, got the green light from governments. They're not going to ban it like everyone thought they were. They may even actually start buying it. They have officially created the Bitcoin reserve. It's just like, well, if you still think that this is a very risky thing to do, even with a small portion of your portfolio, I would highly encourage you to rethink that. So let's go ahead into some of the numbers
And
where,
real quick on
you
that,
know,
I think
how's the next?
one thing that can be helpful when saying, okay, this time period is, let's take an example outside of Bitcoin. And let's say, okay, Uber. Uber was founded in 2009, right? Right around the same time Bitcoin was introduced. And it's like we think about Uber today, and it's like, sure, there's many people who haven't used Uber, but it's a fairly
Yeah.
brand name at this point, right? Like it's fairly ingrained in the culture, especially in cities
Mm-hmm.
and metro areas. And so it's like, okay, so we have a
Yes.
company that over that time frame, and I'm not saying that that's not a recommendation to go invest in Uber. I'm just saying, like, from a standpoint of, okay, how long has Bitcoin been around? That's how long it's been around. And okay, yeah, we've heard about it, we've seen it. It's maybe not felt its presence as much as Uber has, but the
Yeah.
same premise is there. Like people have some sort of idea about Uber now, and like they know what to do, they know how to use it, all this other sort of stuff. So I think that is kind of helpful to think through
Yeah.
this. Oh yeah, like yeah, that's a brand name company that it feels like it's been around for forever. Well, yeah, Bitcoin was started like 1 year earlier than what that was. So it's a
Yeah.
cool way to think about it, I suppose.
No, that's a great point. And I think, also to that point, I think YouTube was like 2007 or something. So, even that's just a little bit earlier. But yeah, if we just think about Bitcoin being a brand new technology, it's like, okay, how many years did you need to be able to start using the internet, or start sending emails instead of physical mail, or to start driving cars instead of riding horses? It's like, how many years did you need to see that, oh, this is a better technology, to be able to then say, I'm going to get in on this better technology because it improves my life? I know that that's deeper down the Bitcoin rabbit hole. And so if that sounded like another language to whoever's listening, to go do some research. But that's essentially what we're looking at here, is like, it's a better technology. And it's like, how many years, are you waiting for a longer track record, or are you just slow to come to understand this? We'll see. We'll see what the future holds. But let's just say, let's look at the portfolio backtest numbers with just a small allocation to Bitcoin. Because, at the end of the day, we don't know what the future holds. Yes, all of these things we're saying for Bitcoin, there are also the potential downsides that could come to pass. Whether this doesn't perform into the future and it kind of stays flat for a while, who knows? Or maybe it dies out. These are possibilities, and a lot of people don't like to acknowledge them, but that's why we can just allocate a small percentage of our portfolio to Bitcoin to start with, and it can still give you these better outcomes than ignoring it altogether. So I put together some just quick, again, high level numbers since January 2018. Again, we're excluding 2017 and any earlier Bitcoin numbers because they are very extreme. But a 60-40 portfolio has experienced an 8.61% compound annual growth rate. If you took 5% out of equities and put that into Bitcoin, so if you have 55% equities, 40% fixed income, 5% Bitcoin, your compound annual growth rate since January 2018 is 11.56%. So we already have a 3% boost just with a 5% allocation, and we kept 40% allocation to bonds. We took it out of equities, not out of bonds. If we jump to a 10% and we take that 10% from equities, we jump to a 14.2% compound annual growth rate since 2018. And that might not seem like a lot, but that's a 6% difference. And I'll get into what that difference could mean over time. Over a 20, 30 year period of retirement, it's very significant, even though the numbers don't sound significant. There's extremely different outcomes. But before we get there, usually the problem most people will have is they'll say, well, I'm not comfortable with the volatility, or I'm not comfortable with the, max drawdown is what we would refer to it as. Volatility, as you like to explain it, is kind of how bumpy is your portfolio along the ride. Max drawdown is, how low did we go at any certain point? And so I put in the max drawdown numbers as well for these portfolios, so we could get an idea for, okay, we're getting better returns, but what's the drawdown experience look like? So for a 60-40 since 2018, the max drawdown was negative 20.69%, which honestly, I was surprised. I'd be curious to hear your thoughts. I was surprised to hear that. 20%, because the S&P 500 over that time was like 23%. Like, it's really not even that much different, but you just capped your growth or your upside. And you still got a majority of the downside experience in this portfolio. So yeah, what are your thoughts before I continue on?
I mean, I honestly think it was just the COVID crash is when that drop happened, or the max drop happened, and basically every asset went the same way: bonds, equities, gold, everything. And so, yeah, in that example, like, diversification no longer worked and everything went down. So that's, I think that's the simple explanation. And I mean, part of our thesis is that we can see that sort of not severity of an event, but that sort of mindset that most assets move more in tandem or more correlated across time. Continue that correlation and continue to get stronger as we go forward. But yeah, that's the unfortunate part. There is bonds probably didn't play their diversifying effect very well.
Yeah, absolutely. And never mind. So the 60-40, again, negative 20.69 over the past 7 years. The 5% Bitcoin allocation had a max drawdown of negative 23%. The 10% Bitcoin allocation had a max drawdown of negative 26%. So High level, maybe zooming out. I wouldn't see this. Me personally, I wouldn't see this as a big difference. But okay, you're living off of the assets. You're in retirement. You're a little bit more risk averse. I could see that being a decent difference. I mean, on $1 million portfolio, that's another $60,000 that you went down. Assuming you started at 1 million and went down 26% versus 20. That could be a year's worth of expenses from your portfolio right there. So, it's enough to not enjoy the ride, if you will. But one thing that we've been able to do with our clients is, we've been able to craft an active strategy where, if we just placed a simple moving average filter onto Bitcoin, and what that means is, okay, when Bitcoin's above its moving average, which we're looking at historical prices of Bitcoin, we're adding up those prices and dividing by the number of days. So if Bitcoin is above its moving average, we are holding it. If it's below its moving average, we are holding cash. So effectively, what we're doing in this situation is we're giving our clients that downside protection to help them smooth out this volatility so that they can, again, get this upside growth potential that we're talking about, but they don't have to experience the entire downside, which is usually most people's argument against adding Bitcoin in any amount to their portfolio. So if we can protect your downside, how would that change the overall experience? So since, again, over the same time frame, since 2018, a 60/40, again, compound annual growth rate 8.61% with a max drawdown of 20.69. The 5% Bitcoin allocation with this downside protection, it had a compound annual growth rate of 10.94%. All right, so we got a little bit less upside, but the downside, the max drawdown, was the exact same as the 60/40, so 20.21, very, slightly better, we'll say. And then the 10% Bitcoin allocation had a compound annual growth rate of 13.17. And again, max drawdown 20.74, almost identical to the 60/40 portfolio. So that's a 5% jump in a compound annual growth rate over that time with the exact same downside experience as a 60/40 portfolio. And this is why it's so compelling to even consider adding a small percentage of your retirement portfolio into Bitcoin. Because if you think about it, like, you still have a long-term time horizon on most of your assets. Even when you get into retirement, you're only living off of, we'll just say 4%, just to throw out that rule of thumb. We'll say you're only living off of a small percentage of your portfolio in the short term. But the long term, most of your assets still need to be growing over the long term. We can't just go all into cash and expect our assets to last us a 20, 30-year retirement. And so a 5%, increase in your compound annual growth rate, just to give you an idea, over a 30-year period, if you started with $1 million, and you can just Google compound annual growth rate calculator and run these same numbers. There's nothing fancy here, but 8% compound annual growth rate, starting with $1 million over 30 years, you end with $10 million approximately. But with a 13% compound annual growth rate, and again, this is the difference between a 60/40 and then a 50/40/10 with a 10% allocation to Bitcoin, a 13% compound annual growth rate, ending balance 39 million. So we're talking about 20, my mental math, 29 million more dollars over a 30-year retirement period. Obviously, yeah, you're going to be spending off of that, drawing down, whatever. We're not going to see completely 13% every single year. There's going to be volatility, but I just wanted to drive that home. The difference in just a few percentage points, in your annual growth rate can be the difference of millions of dollars, in a retirement period.
Mm-hmm. And the other important thing to recognize is that both of those numbers seem huge, right? A million to 10 million, a million to 39 million, like they both seem huge. But you quite literally can almost think of that 10 million and 39 million as like $1 million in today's money or $3.9 million in today's money. just to, kind of root people. Because, like, again, they sound huge today. And I'm not saying there's definite growth there, but that's a I guess good way to think about it in some sense is, that's how we could think about those
Sure.
more in modern dollars. But yeah, I mean, you hit the nail on the head. Like,
Yeah.
this is where it gets compelling. Yeah, especially if we can use some sort of, simple, logic backed and really research backed, trend type strategies on this. It can get very compelling to have or add to the portfolio, I should say, through environment. I mean, 2018 unfortunately hasn't seen every single environment necessarily, right? We really haven't seen a big bear market since the 2008 financial crisis. You could say 2018 was kind of a mini one, and 2022 is an even minier one, but an actual prolonged bear market. All of this stuff is theoretically untested through that. Obviously,
Yeah.
the 60/40 we can go back to, prior to that. We just haven't shown that in this back test, but that's the only downside to this is, we don't really have
Yeah.
good information to show you, hey, here's what happened historically during these sort of market type environments. But even still, yeah, we've seen, the 2018 crash in Bitcoin specifically, but also other assets, COVID in 2022, and this thing still, has performed over that. So at the very least, it's compelling. It's not, it's not for everybody still, right? It's still like, hey, if Bitcoin doesn't work out or you think it's not going to work out, then okay, allocating any money to it
Yeah.
is imprudent in that, right? Because it's like, why would I just guarantee myself a 5% loss, even if historically XYZ, right? So it can still be imprudent,
Yeah.
but this is at least why we get to the point of why you should consider it, right? Basically, excess upside, a downside experience that's at least somewhat similar to what you're going to feel with a traditional portfolio. That right there is compelling, especially when that experience can be backed up not just with the total return numbers like we said, but also these risk adjusted numbers. So risk adjusted, again, to bring this back through, you're talking about these max drawdowns. That's what we're talking about is we can basically measure, okay, based on these sort of drawdown metrics on a portfolio, how much reward did we get over time, and were we actually rewarded for that, excess reward, so to say, so that difference that we're seeing in performance over
Yeah.
time. And what we're saying is, yeah, historically, over the last 7 years, yes, it has been. Certainly going back farther than that with the Bitcoin price, yeah, you definitely were then too. But yeah, to your point, 2017 prior is a different Bitcoin environment.
Yeah. Yeah. I mean, those people got rewarded for the risks they took early on in Bitcoin, that's for sure. So I feel like 2018 to now is a more, maybe more so what we can expect going into the future rather than previous to that. But, if, just to reiterate, we created this active strategy for folks who are, nearing retirement, in retirement. I mean, it's really for everybody, but we found it to be a great fit for people in these situations. And so if you're looking to incorporate Bitcoin alongside traditional assets into your portfolio with an active strategy that gives you that downside protection so that you can have, again, the upside potential of a Bitcoin allocation with the downside protection so that you're not seeing 50, 60, 70% drawdowns in your portfolio, you go check out another video of ours. It is a recent video called A More Intelligent Approach to ETF Investing. And we'll break down that complete strategy with, multiple different portfolio allocations, and they can be customized to you and your situation as well. So anything else to add before we go into the number 2 and number 3 reasons why you may want to include Bitcoin in your retirement portfolio?
Nope, I think we'd be beating a dead horse at that rate.
Sure. All right. Awesome. So, the number 2 reason why you would or should consider adding Bitcoin into your retirement portfolio is Bitcoin actually lowers the risk in your portfolio through true diversification. So, most people hearing that, they're like, wait a second, how would adding Bitcoin to my retirement portfolio actually lower the risk of my overall investment portfolio? That is because Bitcoin, it it may, be volatile. We've spoken to that already with max drawdown and volatility numbers. It may go up and down, faster, if you will, than most other assets that you could be used to. But it also gives you exposure to a new asset class that has never existed before prior to 2009. And so all of the sudden, let's say you're invested in stocks, you're invested in bonds, you may have some commodities as well, like gold or other things. And now you have Bitcoin in there also. Now you're exposed to four different asset classes, and that can give you additional diversification in your portfolio. And we can prove this out with numbers all day long. We won't go into those. Right now, you can again go watch that previous video that I just mentioned if you want to see specific numbers around this. But Bitcoin really introduces a brand new asset and asset class, like you mentioned earlier, that we just haven't even seen in the world before. And so now we can have additional diversification through Bitcoin that we could not get before, in history. So it's pretty compelling to me.
And some people might question that and say, well, but I thought Bitcoin is classified as a commodity, or I thought Bitcoin is classified as property. So no, that falls within a current bucket. And sure, maybe tax classification, they've got to put it somewhere, right? They want their piece of the pie and taxing it, so they got to classify it as something so they know how to tax it. But that still doesn't take away from the reality that literally until the internet, we didn't even have the ability to have something like Bitcoin, right? So that's, 60 years ago, right? Internet was created roughly, something like that,
Yeah.
60s, 70s, somewhere in there. So, okay, we didn't even have the ability to then, right? Until then, I should say. And then it took, however long and for it to actually be created. And then it's like, okay, it's got attributes of some other stuff. Maybe, we hear this digital gold mantra. Okay, it's got attributes of digital gold. It's got attributes maybe of real estate. It's a digital land grab, so to say. Like, yeah, sure, it kind of shares those, but it's still completely different from those things. Those are not a programmatic thing or programmatic
Yeah.
asset that is, not owned, but not controlled either. Let's decentralize. That's what I'm trying to get to. Whatever you want to see of that decentralization, we don't have that really with any other asset. And I know you said
Yes.
the whole like, hey, we don't want to, or we're not going to show numbers, or we're not going to show, the reason for the diversification in here. But if I can get my screen to share, which maybe, yeah, there we go. If I can share this real quick, because I do think it's important to kind of talk through this. So, when we say diversification, there's many kind of ways you can think of diversification, but one of the best ways is to look at what we call correlation. So correlation is a 1 to -1 scale. If you have an asset and then, asset A, asset B, it's if they have a 1 correlation, that means asset B moves up, asset A moves up. Asset A moves up, asset B moves up, vice versa. If it moves down, same thing. A -1 correlation means that if asset A moves up, then asset B is going to move down, right? So it's inversely correlated, and the higher that number, the stronger the inverse correlation. So a correlation number closer to 0 means that, okay, if asset A moves up, that means that asset B might move up, might move down, might do nothing, right? We don't know. So that's an uncorrelated result. And really, that is one of the root, or at least fundamental aspects of diversification, is we want to have assets that are uncorrelated to each other. Right. So we talked about 2020, the COVID crash being like, okay, yeah, that was, why did 60/40 really not do much better to the downside than, a S&P 500? That's because everything became correlated all of a sudden after, a long time of really not being correlated. So, when we talk about correlations, there's always this idea we need to keep in mind of what time period are we looking at, right? Because sure, we can say stocks and bonds are uncorrelated when we look at their 100-year history. But as was shown in the COVID crash, there are periods where that correlation, that uncorrelated nature, I should say, doesn't happen. But even still, so this is, monthly correlations. I won't get into all that, but basically what I want to get at here is if we just look at this Bitcoin line, right? So what we have is we have Bitcoin, and then we've got the Vanguard total stocks, so all U.S. stocks. We have Vanguard real estate, so real estate index, total international stocks, total bond market, and then gold shares, so the price of gold. And so what we can do if we look across this Bitcoin line here is what we see is Bitcoin does not have a single asset that it has a high correlation to. It's highly correlated to itself. It's perfectly correlated to itself, right? That makes sense. But with every other assets, whether it's domestic stocks, international stocks, real estate, bonds, or gold, we have it is uncorrelated historically from those. Now, is there times when, okay, yeah, Bitcoin kind of moves in tandem
Mm.
with, gold or the stock market? Sure. That doesn't, but that doesn't mean that, okay, there's other times where it doesn't. And so that's kind of what I'm trying
Yeah.
to show here is that when we talk about this diversification benefit over Bitcoin's history, and really
Mm.
you can look back over any time period, maybe the correlations have gotten a little higher to things like stocks in the more recent future. But we still don't have something like when we look at the total
Right.
US stock market compared to real estate and to the international stock market, where, it's, yeah, 0.86, 86% or 80% correlated to those various markets, to real estate, to international markets. So it's really something here where
Yeah.
this is the root of that diversification, like above and beyond the fact that yes, it's a segregated and a new asset class. It is those things, and because it is
Yeah.
those things, we can see that in some of the data that I just showed there.
Yeah. No, that's absolutely true. And, that's the kind of quantitative argument for diversification around Bitcoin and other assets. If we just speak to the more qualitative side, Bitcoin is I won't say it's the first, but it is a completely neutral asset. So the other one that Bitcoin often gets compared to is gold, meaning it's completely neutral to a country, a company, or a person, a government. It is, a worldwide neutral asset. However, Bitcoin now is the first digital neutral asset. And so that is where we can get, again, this diversification, because it doesn't matter what the US decides to do. If the world decides to embrace Bitcoin and the US decides to crack down on it, okay, we're not going to experience a significant drop in the value of our Bitcoin holdings just because the US would do that. Like if we only held the S&P 500, for example, the S&P 500, let's say the US, country, something happens and our economy tanks. I don't know. The dollar is no longer the reserve currency. I don't know. Whatever that looks like. Fully allocated, if you're fully allocated to US stocks, well, your portfolio is going to experience a nightmare situation. Whereas with Bitcoin, it doesn't matter what happens in one specific country, company, or government, person, whoever. It is a worldwide neutral asset that people in other countries can benefit from, even if there may be economic troubles, political uncertainty, whatever it may be in one specific country around the world. And so I know that people may argue back against that with, okay, well, whatever the US does, the rest of the world's going to follow. And it's just not necessarily the case. We have, an asset where game theory is playing out here to where, okay, if the US doesn't act, whatever, these other countries, whoever acts first out of the big countries, will say, is going to get the advantage,
Well, and even
around
further,
adopting Bitcoin on a larger scale.
like, okay, the world follows the US. Okay, then why do we have this whole BRICS thing happening, right? Like, why do we have this alternative competing, currency basically to compete against the US dollar? Why do we have these countries forming to do this? Like, okay, because they're realizing that, hey, we can, right? And this has nothing to do with Bitcoin. This is
Yeah.
just the fact that it's like, okay, world follows Bitcoin, or excuse me, the world follows the US.
Yeah.
Sure, maybe historically, we're in a different time now, though. I mean, we really are, and that doesn't, I'm not. That's not an argument for Bitcoin necessarily. It's just the acknowledgement of like, hey, again, like maybe the
Yeah.
way things have worked over the last 50 or 100 years, it might
Yeah.
truly be different now, right? People have said that for a long time, but there's really good reason that really could be not like right now today necessarily things are substantially changing, but at least in the somewhat maybe near future, like sure, like you could make a good argument for that. So it's just
Yeah.
that whole U.S. leads. We're like, sure, yeah. I mean, for many countries, but there's a reason people are getting weary about holding the dollar. There's a reason gold is hitting all-time highs. For like the last 6 months or a year, if not more, right? Just continuing to all-time high after all-time high.
Yeah.
Why do we think that is? Well, because there's other countries in the world that are saying, hey, maybe we want to hold a more neutral asset, historically neutral asset in gold versus holding as many dollars,
Yeah.
from another country on our balance sheet. So, anywho,
Yeah. No, you're spot on. That's a great point to make. They'd rather hold gold, an appreciating asset, versus the dollar or treasuries, which are basically a depreciating asset and depreciating faster than ever. And they don't want to be under the thumb of the United States. And so, to your point, they don't want their economic or their economy to be completely dependent on whatever the U.S. is doing or whatever the U.S. decides to do to them with sanctions or whatever it may be. And so, they're taking the steps to protect their financial situation by accumulating gold, and then they will come to see Bitcoin as that opportunity very, very soon if they are not already, because compared to gold, Bitcoin is better in many ways. It's digital, so it takes a lot less time or a lot less manpower and money to secure it. Also, to move it, if you're going to spend it, it's going to be hard to transport that back and forth. Whereas with Bitcoin, you can secure it very easily for a small amount of money, and you can transact with it very quickly, anywhere in the world. Again, for a small amount of money, and that's not dependent on anyone else giving you the thumbs up saying, "Hey, yeah, you can do this." Not to mention, Bitcoin has a fixed supply, whereas gold does not. New gold is being mined constantly. And so as governments start to wake up to this, which, I think they already are, Bitcoin has been talked about more in the news over these past, maybe this is just my echo chamber, but it seems like it's been talked about more in the news over the past 3 months or since Trump got into office than ever before. And so, if you want to get ahead of this and try to see this before these big market movers come in, I think your time is running out, we'll say. So, any other thoughts to add on the Bitcoin lowering risk in your portfolio before we move on to the third and final reason?
well, we've already moved on to the third and final reason. Basically, I mean, that stuff was more of the third reason
Yes.
as diversification.
Yes, that's true. I got ahead of myself. And in creating these three reasons, it was tough to delineate two from three, but I wanted to have three because three sounds better than two. People will more likely listen if it's three things versus two things. But yeah, like you said, the third reason is Bitcoin offers protection against inflation, hyperinflation, or potential collapse of, I put the US dollar, but we could just say fiat currencies at large. You are, by owning Bitcoin, holding Bitcoin in your portfolio, you are protecting your family, the hard earned savings that you've accumulated over your life. You're protecting it against politicians, against governments, against central bankers devaluing, your savings and what you have worked hard and exchanged value with the world to save up for this retirement period. You're protecting it from them being able to print away your retirement, if you will. And what I mean by that, a great example was during COVID. We saw a 40% increase in the overall money supply in the United States over a, I don't know, 12-month period. That is essentially, just to translate what that means for someone who's in retirement, that is 2/5 of your savings gone, if you want to think about it that way. Imagine you retired in 2020, you had $1 million. Let's just say it was sitting in cash. They print 40% more dollars into the system. And now all of a sudden your $1 million that was worth $1 million as of, before this pre-print, if you will, is now worth $600,000 effectively in purchasing power terms. And so that's where owning something that cannot be printed, it cannot be debased, can be so valuable for your long-term savings in retirement, because you're not at the whim of, the government or central bank deciding, hey, we need more dollars in the system to keep up this house of cards. All right, let's turn on the money printers.
Yeah. An analogous way to think about this is there's really two of them. Because we say here, okay, potential collapse of the U.S. dollar. What does that really mean, right? What does collapse mean? Some people will tell you it's like a dam breaking, right? Dam breaks, all of a sudden we've got huge, horrible floods, all this sort of catastrophic stuff, right? Sure. Could that happen? Sure. But more likely, and what we're trying to say here is this, collapse is more like erosion over time, right? Like 2.5 hours from here, we have the Royal Gorge and the Arkansas River running below it, right? That 1,000 feet, canyon walls basically just straight up. Well, those didn't just necessarily happen overnight, right? That wasn't a dam broke and then all of a sudden, that was formed, right? That was an extremely long
Sure.
time and process that actually broke that down, and that's more like what is happening with our dollar than necessarily a dam breaking. Now, both could happen, right? We could have this kind of erosion process, right? That's happening
Yeah.
kind of slowly, where downstream that slow erosion is actually all collecting in a dam that may eventually break. Like, sure, that could also be a potential, but that's more what we're getting at here. It's not so much it's like the end of the world, all this sort of thing. It's more just the fact that, like, hey, like, yeah, your dollar is slowly eroding over time, and kind of like a river, and when these huge gorges are formed, is there's going to be periods where yeah, that does happen
Yeah.
actually fairly quickly, right? Where it does erode, a couple feet in a year all of a sudden after being inches for however many years prior
Yeah.
to that. But that's still not the same thing as like a complete
Yeah.
dam collapse where water's just flooding everywhere either.
Yeah, 100%. Like you're saying, it can speed up over time, even though it may be slow to the point where it's not noticeable day to day. It can continuously become faster and faster until everyone has seen an exponential graph where it's like slow, 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 and then all of a sudden it just turns up really fast. I mean, that is essentially what we could see. And just to put some numbers behind this, the money supply, the M2 measured by M2, which I think it's kind of best we have at this point. The M2 money supply in the U.S. has grown. The annual growth rate since 2007 is 6.5%. So if your portfolio, your wealth has not outgrown 6.5% over that time from '07 to 2025, then you've actually lost wealth over that period. Whereas, okay, if we go back, I wish I would have grabbed the 60/40 number since 2007. I don't know why I didn't. But a 60/40 portfolios, even since, let's see, since 2018 is the number that I do have, is 8.61%. If we go back to 2011, 8.6%. So, you're barely outpacing the overall money supply increase. And if you're in retirement and you're actually withdrawing money, you're going to experience a much different rate of return than 8.6%. And so you are probably going backwards in more ways than one. The other point I want to make here, really quick, before we wrap up, the money supply growth is accelerating as well. So, yes, since '07, we have 6.5% per year. It's growing. Since 2020 through today, we have a 7.9% compound annual growth rate on the money supply. If we just look at the government debt, US government debt, it is 8.25% compound annual growth rate since '07. And this is getting faster as well, 9.29% since January 2020. Like, you can see how the shorter time frames are higher because this is just like you're saying, it's slow and it's methodical, and it doesn't seem, it's kind of death by a thousand cuts, but it's speeding up, it's speeding up, it's speeding up, and eventually it's going to continue to just grow faster and faster, and there will be this exponential point when it probably continues to devalue very quickly. And so, whether that leads to a long drawn out period of the dollar losing value, or we actually do get this collapse, quote unquote, Bitcoin could be the new monetary system that we can use globally. And so, owning a piece of that when it is completely fixed is compelling in my mind as well. So, we'll go ahead and wrap up here. Those are the three reasons why you should consider holding Bitcoin in your retirement portfolio. Number one, it can boost your returns. Number two, it actually lowers risk in your overall portfolio. And number three, it offers protection against inflation, hyperinflation or potential collapse of the US dollar or fiat currencies in general. So I would highly encourage you to look into it if you haven't already. And if you're interested in our guidance or our active strategy, you can go to strongwealth.net. You can schedule a free discovery call with us there, and we can talk about if it's a good fit for you in your situation. So thanks for watching, and we'll see you in the next video.